imagine waking up the morning after, the absolute happiest day of your life.
Yeah, you're just riding that massive emotional high.
Exactly. You're making a cup of coffee, maybe you're swiping through some blurry, joyful photos on your phone, and then suddenly the adrenaline just fades and reality hits you.
The financial reality.
Right. You realize that this incredible 6-hour party you just threw has legally committed you to, like, a $600 monthly payment for the next 5 years.
Which is a terrifying thought.
It really is. You're staring down the barrel of a financial hangover that is literally going to last half a decade.
So today on the Deep Dive, we are dissecting exactly how to plan a dream wedding without waking up to that specific financial nightmare. And we have some really fantastic source material for this.
We do. We're pulling our insights today from this highly comprehensive master guide on wedding finance put together by the planning platform Weddizer.
Yeah, the guide is called Wedding Loans and Credit Cards, Smart Ways to Finance Your Dream Wedding Without Debt.
Right. And our mission today is to just cut straight through all that intense social media pressure, decode the actual underlying mechanics of wedding financing, and figure out how you can leverage these tools.
So you can actually celebrate your big day without, mortgaging your future peace of mind.
Exactly, because it is a vital conversation. I mean, what we're actually dealing with here isn't just social pressure. It's behavioral economics at its most aggressive.
Oh, absolutely. The wedding industry is incredibly skilled at altering your perception of value.
Right, like how they price things.
Yeah, I mean, when you start planning, you might tour a venue that costs, say, $15,000, but your personal budget might only be $5,000.
Which is a huge gap.
It's massive. But because you've seen that $15,000 price tag, when you later find a venue for $8,000, your brain plays this trick on you.
Oh, it thinks you're getting a bargain.
Exactly. You think, wow, what an incredible steal. You have completely abandoned your original $5,000 limit because that first massive number anchored your perception of reality.
Okay, let's unpack this immediately because I feel like I need to push back slightly just to play devil's advocate for the listener here.
Go for it.
Isn't the entire point of a wedding to kind of, I don't know, suspend reality for a day? I mean, it is truly a once-in-a-lifetime event.
That's the marketing, yeah.
Right, but if you want the hanging floral installations and the imported linens and the 10-piece live band instead of just a DJ with a laptop, why shouldn't a couple just borrow whatever they need to lock in that luxury experience?
Because of what comes after.
But you're buying a memory, right? And you can't put a price tag on a memory.
Well, you are buying a memory, but the problem is you're paying for it with your future reality.
Okay, what do you mean by that?
It raises this really important question about opportunity cost. When you take on debt for non-essential luxury upgrades, those hanging florals or the fancy linens, you don't just pay the invoice on the wedding day.
Right, you pay interest.
You pay interest, but you also pay for them with the money that could have gone toward, like, a down payment on a house.
Oh, wow. Yeah.
Or a robust emergency fund. Or simply your daily peace of mind for the next 3 years. The source is very clear that a truly meaningful wedding is not defined by its aesthetic price tag.
So you're basically mortgaging the financial foundation of your marriage for a few hours of visual perfection.
Exactly. And that completely undermines the actual joy of starting a new life together.
So you don't want to be fighting over the grocery budget in 2029 because you're still paying off the artisanal cheese board from 2026.
Precisely. It's a recipe for resentment.
I hear that. It makes perfect sense. But let's look at the reality on the ground because the upfront costs for the non-negotiables, the space, the food, the photography, they are undeniably massive.
They are. The sticker shock is very real.
And most couples simply do not have 20 or 30 grand sitting liquid in a checking account. So this inevitably drives people toward big financial solutions to bridge the gap.
Right, which usually means looking at loans.
Yeah, let's look at the heavy artillery first, the wedding loan. Break down what that actually is for us.
Sure. So structurally, a wedding loan is just an unsecured personal loan. You borrow a fixed lump sum of money from a lender, and you repay it in predictable monthly installments over a set timeline.
And I can clearly see the appeal here for the big expenses, right?
Right.
You get a fixed monthly payment.
Which obviously makes your future budgeting highly predictable compared to, say, a revolving line of credit.
Yeah, and the guide mentions the interest rates are generally lower than a standard credit card, right?
Usually, yes.
Yeah.
And the cash hits your account relatively quickly so you can lock down those massive deposits.
Right, because venues book up fast. So these loans are specifically designed to be deployed for the heavy hitters. Venue bookings, catering services, photography and videography packages, honeymoon expenses, and the major decor arrangement.
Exactly, the big fixed costs.
So just trying to wrap my head around this mechanically. Taking out a wedding loan is essentially just like taking a car loan, right?
Well, no.
No, but you're just financing a different type of major life event.
We really need to look much closer at that analogy because the underlying financial mechanism is entirely different.
Okay, how so?
When you finance a vehicle, the bank knows that if you lose your job and stop making payments, they can repossess the car.
Oh, right.
They can sell it at auction and recoup their capital. The car acts as collateral. A wedding, on the other hand, has zero collateral.
Because they can't repossess a party.
Exactly. The bank cannot repossess your memories of the reception, and they certainly cannot liquidate your wedding photos to get their money back.
Wow. I hadn't thought about it from the underwriter's perspective.
Right. Because it is an unsecured loan, the risk to the lender is exponentially higher.
So they're basically handing you a massive check entirely on the statistical promise that you are good for it?
Precisely. Which is why the criteria for using these loans are incredibly strict. What's fascinating here is how the source draws a really hard line. This is not a blanket recommendation where anyone can just walk into a bank and get funding for a party.
Okay, so who actually qualifies, practically speaking?
To even consider a wedding loan, you must have a highly stable, reliable income. The lender needs absolute mathematical certainty that you can handle those monthly repayments without straining your daily living expenses.
That makes sense.
Secondly, you need a meticulously clear budget. You borrow exactly what you need to cover the hard, fixed costs, not extra padding because you might want to upgrade the champagne later.
Right. No slush funds.
And finally, there has to be a genuine logistical need for flexibility on major upfront costs.
So if your income fluctuates, like maybe you're a freelancer or you work on commission, or if you already carry a significant amount of student loan or credit card debt, this is a massive red flag.
It is a total non-starter. Taking out a massive unsecured personal loan when your financial foundation is already shaky is the fastest route to a decade of financial hardship.
Yeah, that sounds like a disaster.
You only deploy this tool when you have an ironclad capacity to absorb the resulting monthly payment.
But a personal loan is incredibly rigid, isn't it? It's just a lump sum sitting in your account.
It is. Once it's there, it's there.
So what happens when you are standing in a bakery and you just need to put down a $200 deposit today, or you need to order the bridesmaid dresses online?
You need a different tool for that.
Right, you need liquidity, not a bank transfer. And this brings us to what feels like a highly volatile double-edged sword, which is credit cards.
They are volatile, yeah, but they are also the primary daily utility for wedding planning. If we look at how to use them strategically, credit cards offer a type of leverage that cash simply does not possess.
Leverage is an interesting word here. I know people absolutely obsess over the rewards, using all that wedding spending to rack up travel points, cash back, or miles to effectively pay for the honeymoon flights.
Oh, absolutely. The points game is huge.
That makes total sense. And they obviously offer flexible short-term cash flow before those final big payments are due. But the purchase protection aspect seems even more critical here, based on the guide.
It is arguably the most valuable feature of the credit card ecosystem. Think about the mechanism of a transaction.
Okay, walk me through it.
If you pay a vendor $5,000 in cash and they go out of business the week before your wedding, your money is gone.
Just go on.
You are at the back of a very long line of creditors in bankruptcy court.
Oh.
But if you use a credit card, the credit card network effectively acts as your financial enforcer.
I love that visual. Visa as your personal mob enforcer.
Essentially, yes. If a vendor fails to deliver the contracted service, you initiate a chargeback. The burden of proof instantly shifts to the vendor.
Oh, so they have to prove they did the work.
Right. They have to prove to the credit card network, not just to you, that they delivered the service. If they cannot, the network reverses the charge.
That's incredible peace of mind.
It is. You have a built-in, highly aggressive dispute resolution mechanism that protects your capital.
Here's where it gets really interesting, though. If the rewards are so incredibly lucrative and the consumer protections are that strong, why shouldn't a listener just go online tonight and open 5 or 6 brand new credit cards all at once?
Well, please do not do that.
But think about it. Just snag all those massive sign-up bonuses, hit the minimum spend requirements with the wedding expenses, and practically pay for the entire honeymoon in points. It feels like the ultimate financial life hack.
It feels like a life hack, right up until you look at how credit algorithms actually function.
Okay, burst my bubble. What happens?
When you apply for a credit card, the lender triggers what is called a hard inquiry on your credit report.
And we've all been told hard inquiries are bad, but why? Specifically, what is the algorithm actually seeing?
To a lender's algorithmic risk model, suddenly asking 5 different banks for a line of credit in the exact same week makes you look incredibly desperate.
Oh, wow, like you're drowning.
Yes. It looks like you are panicking, completely starved for cash, and about to take on way more debt than your income can support. Your credit score will plummet.
Which obviously hurts you later.
Severely. It could impact your ability to buy a house or a car later. Furthermore, having sudden, frictionless access to $50,000 or $60,000 in new, revolving credit severely warps your financial discipline.
Because it just feels like free money.
Exactly. It heavily encourages dangerous overspending because the psychological friction of parting with your own money is completely removed.
So you start out trying to game the system, and the system ends up gaming you. You are left holding multiple balances across multiple cards.
And paying astronomical interest.
But wait, what about those 0% APR promotional offers, the ones that say no interest for 18 months? That genuinely seems like free money to float the wedding costs.
It is deferred interest, not free money, and the trap is hidden in the fine print.
There's always fine print.
Always. You should only ever use a 0% promotional offer if you have a rock-solid automated repayment plan to clear the entire balance before the promotional period ends.
And if you don't?
If you miss paying it off by even one single day, or leave a $50 balance when the clock strikes midnight on month 18.
Let me guess, they bump you to the standard 25% rate going forward.
It is much worse than that.
Wait, really?
Yeah, they don't just start charging you interest on the remaining $50 balance. They often backdate the exorbitant interest rate to day one.
Oh my gosh.
You suddenly owe 18 months worth of compound interest on the original purchase price.
That is genuinely terrifying. Okay, so the rules from Weddizer for avoiding the credit card trap are absolute. Set rigid spending limits before you buy.
Yes, absolutely.
Pay the balances immediately, ideally every single month, and absolutely do not treat a credit card as a long-term debt solution.
Correct. Which brings us to the core mechanism that governs all of this.
The budget.
Right. Whether you are using the bank's money via a loan, leveraging a credit card for points, or just draining your own savings, none of this works without a master blueprint. You need a realistic budget to prevent the spending from spiraling.
And the guide identifies underestimating costs as the single biggest mistake couples make in this entire process.
It's so common. People mentally budget for the big three: the venue, the dress, the food.
But the categories that require strict spending limits are incredibly extensive. You have to allocate funds for the venue, the dresses and suits, the food and drinks, the entertainment, the decorations, and even the accommodations for out-of-town guests.
It's a huge logistical undertaking.
It really is. And there is one specific mechanical rule from the source that stood out above everything else. Couples must reserve at least 10 to 15% of their total budget solely as an emergency cushion.
And that's critical. Think of that 10 to 15% not as extra spending money, but as a psychological and financial safety net.
Right, because things go wrong.
In event planning, unexpected costs are not a possibility. They are an absolute mathematical certainty.
Give me an example.
Sure. A vendor backs out at the last minute, and you have to hire a replacement at a premium.
Huge.
Or the forecast calls for torrential rain, and you suddenly need to rent a $2,000 tent 3 days before the event.
That would ruin you if you weren't prepared.
Exactly. If every single dollar of your budget is already spoken for, that unexpected tent forces you into high-interest, unplanned debt. That 15% cushion ensures that a logistical hiccup doesn't escalate into a massive financial crisis.
So what does this all mean for the listener? Because honestly, sitting down to manually track the venue deposits, the suit alterations, the entertainment contracts, the emergency fund, and the credit card limits, I mean, it feels completely paralyzing.
It's overwhelming for sure.
You're trying to manage a hyper-complex financial spreadsheet while simultaneously trying to pick out napkin colors and write your vow.
Which is a terrible way to spend your engagement.
Right. This is where a centralized system becomes critical, and it's why the Weddizer platform is so heavily emphasized in the guide as a solution.
Well, you cannot manage what you do not track. Weddizer effectively acts as the central nervous system for your entire planning process.
So.
It organizes the budgets and tracks real-time outflows all in one place. So if you spend an extra $100 on upgraded lighting, you immediately see how that shrinks the remaining balance for your floral arrangement.
Oh, so it completely removes the abstract nature of the spending.
Exactly.
Yeah.
And the platform also allows you to compare multiple vendors side by side.
Which forces you to evaluate the actual market rate before you just, emotionally commit to the first photographer you meet.
Right, because people fall in love with a portfolio and just throw money at it. And that centralization prevents the death by 1,000 cuts.
What do you mean by that?
Small purchases add up incredibly quickly. $50 here for personalized favors, $100 there for a premium cake tasting.
And it just bleeds you dry.
Yes. Without a real-time tracking system, those microtransactions will entirely drain your 15% emergency cushion before the wedding week even begins.
Okay, let's pivot entirely for a second. Let's say a listener hears all of this. They look at the loan underwriting criteria, they look at the credit card traps, the massive budgets, the spreadsheets, and they just decide they want absolutely zero part in financing.
They just want to pay cash.
Right. They want to avoid borrowing entirely. What are the most effective non-finance alternatives the source recommends to still pull off an incredible event?
The most foundational alternative is simply using time to your advantage.
Like pushing the date back.
Exactly. Extending your engagement to give yourself 18 to 24 months simply to save cash in advance.
That makes a lot of sense.
Setting up a dedicated high-yield savings account and auto-depositing funds every single paycheck completely removes the pressure of needing upfront capital.
What about the actual event logistics?
You can look at strategies like choosing off-season wedding dates. Venues and vendors operate on a strict supply and demand curve.
So January's cheaper than June.
Drastically. Booking a Friday in November is drastically cheaper than booking a Saturday in June, simply because the demand is lower.
And the guide also mentions you can rely on family contributions, assuming family members are actually willing and able to help with specific expenses.
Yes, that's always an option if you're lucky enough to have it.
But my absolute favorite piece of advice from the guide, because it just makes so much mathematical sense, is ruthlessly reducing the guest list.
Oh, it's the ultimate lever you can pull.
Right. I think people assume cutting the guest list just means saving, say, $60 on a plate of chicken for dinner. But it's so much deeper than that, isn't it?
It is a massive financial domino effect. Let's break down the actual mechanics of cutting just 10 guests from your list.
Okay, let's do it. What happens when we cut 10 people?
It is not just saving $600 on catering. 10 fewer guests means one entirely less table required in the dining room.
Oh, right.
One less table means you don't have to buy that $150 floral centerpiece. It means you don't need to rent 10 extra chairs or buy extra linens or send out 5 extra highly expensive invitation suites.
I hadn't even thought about the invitations.
But most importantly, crossing the threshold from 150 guests down to 140 might mean you can suddenly fit into an entirely different, much cheaper tier of venues.
Wow.
You aren't just saving $600. You are potentially saving $3,000 or $4,000 just by triggering that domino effect.
It completely redefines the scale of the infrastructure you are renting. That is such a powerful way to look at it. You aren't cutting people, you are shrinking the footprint of the event.
And if we connect this to the bigger picture, what we're really talking about here is problem solving as a team.
Yeah.
This entire process is elevated far beyond just throwing a party. The source stresses that planning a financially smart wedding is essentially the ultimate training ground for your marriage.
Because it's usually the very first major high-stakes financial project a couple tackles together.
Exactly.
It is the ultimate stress test. You're figuring out how your partner handles compromise, how they handle sticker shock, and how they prioritize fleeting desires versus long-term reality.
And that is exactly why it is imperative to have deep financial conversations long before the wedding day. You have to sit down and discuss future savings goals, how you plan to manage emergency funds, your housing timeline.
How you're going to attack existing debt.
Right, and what your shared budgeting strategy looks like.
Yeah.
The financial mechanics of the wedding are really just a microcosm of how you will handle the next 50 years together.
So the payoff isn't just arriving at the altar without a huge visa bill.
Not at all.
Couples who prioritize this kind of intense, transparent budgeting actually enjoy significantly reduced financial stress, much stronger communication skills, and vastly better long-term stability. You are literally using the wedding planning process to buy peace of mind for your marriage.
A dream wedding should be the launchpad for a joyful, secure future, not an anchor of unnecessary debt that drags you down for the first decade of your life together.
That is the perfect encapsulation of our mission today. So let's summarize the blueprint we've unpacked for you. If you are exploring wedding loans, remember they are powerful tools for large fixed costs, but you must have a highly stable income and a rigid budget. Do not borrow without collateral if your income fluctuates.
Definitely not.
If you are leveraging credit cards, use them as your financial enforcers for vendor protection and rewards, but pay those balances immediately and beware the deferred interest traps.
And always protect your sanity with a 10 to 15% emergency cushion because the unexpected will happen.
It absolutely will. And finally, consider comprehensive tools like Weddizer to build a central nervous system for your budget, track every penny in real time, and compare your vendors objectively.
It all comes down to maintaining deliberate control over the process, rather than letting the emotion of the process control you. And as we wrap up, I want to leave you with a thought that really builds on this idea of post-wedding finances.
What's that?
If the way you and your partner communicate, compromise, and handle the pressure of your wedding budget is a sneak preview of your marriage's financial future, well, what kind of trailer are you currently filming?
Wow. That is definitely something to chew on while you're agonizing over seating charts and napkin fabrics. Thank you so much for joining us on this deep